In 2012, Mark Zuckerberg took out a 30-year mortgage on a $6 million home in Palo Alto. He was already worth billions. He could have written a personal check before lunch and never noticed the money was gone. Instead, he borrowed at 1% and kept his capital working elsewhere. That decision wasn't sentimental. It was mathematical. Most people grow up learning that debt is the enemy. Pay it off fast. Stay out of it if you can. The goal is to owe nothing. And for the kind of debt most people carry, high-interest credit cards, depreciating car loans, that advice is correct. But it's only half the picture, because the same instrument that traps one person is quietly building wealth for another. The difference isn't discipline, it's which side of the spread you're on. The spread. That's the concept at the center of this video. It's the gap between what borrowed money costs you and what it earns when you put it to work. Once you understand how that gap functions, you stop seeing debt as a burden and start seeing it as a variable, one you can control. My name is Alex, and if you've ever felt like you're doing everything right financially but still falling behind, stay with me, because the mechanics of how wealthy people actually use debt are rarely explained clearly, and I'm going to walk you through 5 of them. Once you understand the spread, the rest of the strategies in this video will feel less like secrets and more like math you just hadn't been shown yet. That math starts with the most fundamental mechanism of all, how borrowed money generates a return simply by existing on the right side of an equation. Most people think the wealthy are rich because they have more money. That's true, but it's incomplete. The more accurate version is that they have more money working at a higher speed, in more places, using capital they never actually owned. That distinction sounds abstract until you run the numbers, and then it's the only thing that makes sense. Here's the core idea. A loan is rented money. The interest rate is the rent. And just like renting an apartment to a tenant who pays more than your mortgage, the only question that matters is whether what you do with that borrowed money earns more than what it costs you to borrow it. The gap between those two numbers is the spread. And the spread is everything. The formula looks like this. Return equals spread multiplied by leverage. Spread is the difference between your borrowing cost and your investment return. Leverage is how many borrowed dollars you've stacked on top of your own. If you borrow at 4% and invest at 8%, your spread is 4%. Now multiply that across $500,000 of borrowed capital. That's $20,000 a year in profit, on money you didn't have to begin with. Think about what that actually means. You are generating income from a resource you temporarily rented. The bank takes its cut. You keep the rest. This is not a loophole. It's just arithmetic that most people were never shown. Now here's where it gets interesting. The spread doesn't just reward you for investing well. It also rewards you simply for borrowing cheaply. A higher credit score isn't just a number that makes lenders smile. It's a direct reduction in your cost of capital. Drop your borrowing rate by 1.5 percentage points, and on a $400,000 loan, you've just freed up $6,000 a year, every year, for 30 years. That's $180,000 over the life of the loan, not from investing better, just from being a cheaper borrower. Let me give you a concrete example of how this plays out. Sarah is a marketing director earning $92,000 a year. A few years ago, she took out a home equity line of credit at 5.5% and used it to invest in a diversified index fund. Currently, broad market index funds are averaging returns somewhere between 7 and 9% annually, depending on the time horizon. Her spread sits at roughly 2 to 3%. On $100,000 borrowed, that's $2,000 to $3,000 a year in net gain, after paying the rent on the money. She didn't invent a product. She didn't take a second job. She just positioned herself on the right side of the equation. Now, you're probably thinking, isn't that just risk dressed up as strategy? And yeah, on the surface, that seems right. Borrowing to invest carries real downside. If the market drops, the loan doesn't drop with it. You still owe what you borrowed. That's the guardrail you have to keep in your peripheral vision at all times. The spread only works in your favor when the return on the asset consistently exceeds the cost of the debt. The moment that flips, if rates spike or returns collapse, the math runs in reverse just as efficiently. This is why the wealthy don't just borrow aggressively. They borrow selectively. They target assets with predictable returns or income streams that can reliably service the debt, regardless of what markets do in a given quarter. The loan is a tool. Like any tool, what matters is whether you're using it on the right material. Here's the actual takeaway from this section. Debt is not inherently destructive or constructive. It's a multiplier. It amplifies whatever return the underlying asset produces, positive or negative. The wealthy understand this instinctively. They spend less time asking whether to use debt and more time asking whether the spread justifies it. And that logic doesn't stop at borrowing to invest. It extends to physical assets, specifically real estate, where the strategy goes one step further. Not just earning a return on borrowed money, but eventually pulling that borrowed capital back out entirely, leaving you with an asset you no longer have a single dollar of your own money tied up in. That's what infinite returns actually means. And it's where the math starts to feel less like finance and more like a magic trick that turns out to be completely real. There is a number in real estate investing that shouldn't be mathematically possible. It looks like a glitch, but it shows up repeatedly across thousands of deals, and it's completely legal. The number is infinity, as in an infinite return on your invested capital. Not because someone got lucky, because they engineered the math to divide by zero. Here's how that works. The spread from Section 1 explains how borrowed money generates profit when deployed at a higher return than its cost. But real estate adds a second layer on top of that. It lets you recover your original capital entirely, pull it back out of the deal, while still owning the asset. When you have zero of your own money left in a deal that's still generating income, your return on that zero is not zero. It's infinite. You can't divide by nothing and get a number. That's the point. The mechanism is called a cash-out refinance. And the sequence, done correctly, goes like this. Marcus is a high school teacher who spent 3 years quietly studying real estate on weekends. He finds a dated but structurally sound duplex listed at $480,000 in a mid-sized city where rents are climbing. He puts 20% down, $96,000, and takes a mortgage on the remaining $384,000. Then he spends the next several months renovating. New kitchen, updated bathrooms, fresh exterior. Total renovation cost out of pocket, $62,000. His total personal capital in the deal is now $158,000. Here's what the renovation did. The appraised value of the property moves from $480,000 to $690,000. That's not magic. Forced appreciation through targeted improvement is one of the most reliable value creation mechanisms in real estate, particularly in undersupplied rental markets. Currently, well-executed renovations in strong rental markets are generating value increases of 30 to 50% above the cost of the work itself. Marcus is well inside that range. Now he goes back to the bank. He refinances at 80% of the new appraised value. 80% of $690,000 is $552,000. Out of that, he pays off the original mortgage of $384,000. That leaves him with $168,000 in cash. His original investment was $158,000. He just got every dollar back, plus $10,000 on top. His own capital in the deal is now zero, and he still owns a $690,000 property generating rental income every month. Now you're probably thinking, wait, but doesn't he have a larger mortgage now? Yes. The new loan is bigger than the original. That's why the rental income has to carry the debt service. If the rent covers the mortgage, taxes, insurance, and maintenance with something left over, the deal works. If it doesn't, the whole structure collapses. This is not a strategy that tolerates sloppy underwriting. The numbers have to be run honestly before the first dollar goes in, not after. But when the numbers do work, and in markets with strong rental demand, they often do, the result is genuinely striking. Marcus has a six-figure asset producing monthly cash flow, and he has his original capital sitting in his bank account, available to do the entire thing again. That's the velocity piece that makes real estate compounding, different from almost anything else. The same money funds the next deal, and the next. Each time, the investor owns more. Each time, their personal capital is recycled rather than locked up. The infinite return isn't a headline. It's just what happens when you structure debt correctly around an appreciating, income-producing asset and have the patience to let the sequence complete. And the sequence doesn't stop at appreciation and cash flow. Because once you own assets with real value sitting on the books, the tax system introduces another layer, one that most people never see coming. Debt, it turns out, doesn't just help you buy assets. It helps you make those assets produce a paper loss that quietly erases a portion of your tax bill every single year. That mechanism has a name. It's called the depreciation shield, and it's where the relationship between debt and taxes starts to get genuinely surprising. The federal government lets you tell the IRS that your property is losing value while your tenant pays you rent, your equity grows, and the market pushes your assets worth higher every year. You report a loss on paper while making money in reality, and that paper loss reduces the taxes you owe on your actual income. This is not a gray area. It is written into the tax code. It has been there for decades. And almost nobody outside of real estate investing circles talks about it clearly. Here's the mechanism. When you buy a residential rental property, the IRS assumes the building, not the land, just the structure, wears out over 27 and a half years. So they allow you to deduct a portion of the building's value from your taxable income every single year, even if the property is appreciating in the real world. That annual deduction is called depreciation. And because debt is what allowed you to buy the asset in the first place, debt is what makes this deduction possible at the scale that matters. Let's put numbers to it. Diana is a registered nurse who purchased a rental property valued at $420,000. The land is worth $80,000. So the depreciable basis, the building itself, is $340,000. Divide that by 27 and a half years, and Diana gets a depreciation deduction of roughly $12,360 every year. That deduction comes straight off her taxable income. If she's in the 32% federal bracket, that single deduction saves her nearly $4,000 in taxes annually, every year, without selling anything, without spending anything, just from owning the asset that debt helped her buy. Now here's where it gets more interesting. There's an acceleration strategy called cost segregation. Instead of depreciating the entire building over 27 and a half years, a cost segregation study breaks the property into its individual components: flooring, fixtures, appliances, landscaping, electrical systems, and assigns each one a shorter depreciation schedule. Some components depreciate over 5 years, some over 15. The result is a much larger deduction concentrated in the early years of ownership, when it's often most useful. Currently, investors who commission cost segregation studies on properties above $400,000 are front-loading depreciation deductions that can temporarily wipe out several years of rental income from a tax perspective entirely. That's not a loophole. That's the tax code functioning exactly as written, rewarding capital deployment into housing with a structural tax advantage. Now you're probably thinking, doesn't this create a problem when you sell? And yes, it does. When the property is eventually sold, the IRS recaptures the depreciation through a 25% tax on the amount previously deducted. That's called depreciation recapture. It's real and it matters. But here's what sophisticated investors do with that. They defer the sale indefinitely through refinancing, exactly as described in Section 2. Or they execute a 103-1 exchange, rolling the proceeds directly into a new property and pushing the tax liability forward again. The bill exists, it just never seems to come due. What makes the depreciation shield genuinely powerful is the combination. Debt funds the asset generates rental income. The depreciation offsets that income, and sometimes offsets other income too, depending on your tax situation and whether you qualify as a real estate professional under IRS rules. You are simultaneously building equity, collecting rent, and reporting a paper loss that reduces what you owe the government. 3 things are happening at once, driven by a single decision to borrow and buy. Diana's property is worth more than when she bought it. Her tenant is paying down her mortgage, and she is reporting a loss to the IRS. All 3 of those sentences are true at the same time. That's what debt, structured correctly around the right asset, actually produces. But the depreciation shield works at the level of individual properties and income. The strategy that operates at the level of entire fortunes, the one billionaires use to access hundreds of millions of dollars without selling a single share and without triggering a single dollar of tax, runs on a completely different mechanism. It doesn't involve real estate at all. It involves borrowing against wealth itself, and it goes by a name that sounds almost too blunt to be real. Buy, borrow, die. At some point, the tax math becomes so lopsided that selling feels less like a financial decision and more like a penalty. And when the penalty is large enough, the wealthy stop selling entirely, not occasionally, permanently. What replaces selling is borrowing. And the structure they've built to do it is so efficient that it functions as a parallel financial system, one where income is optional because liquidity comes from debt instead. Here's the setup. When you own appreciating assets, stocks, private equity, a business, you are wealthy on paper, but cash poor in practice. The value is real. You just can't spend it without triggering a tax event. Currently, long-term capital gains are taxed at a maximum federal rate of 23.8% for high earners, once you include the net investment income surtax. On a $50 million position that cost you $2 million to build, selling means handing roughly $11 million to the IRS before you see a cent of usable cash. That is the penalty for selling. So they don't sell. They borrow. Here's how it works in practice. Thomas is a software entrepreneur whose company went public several years ago. He still holds a significant equity position currently worth $60 million. He needs liquidity, not because he's struggling, but because opportunity doesn't wait for convenient tax timing. He pledges his portfolio as collateral to a private bank and takes out a portfolio loan at roughly 6 to 7% interest. Currently, that's the range most major lenders are offering on securities-backed lines of credit for portfolios of this size. The bank gets collateral, Thomas gets cash. And because borrowed money is not classified as income under the U.S. tax code, not a single dollar of that loan triggers a tax event. He is spending money he doesn't technically have, secured against wealth he hasn't sold, paying interest instead of taxes, and keeping his entire equity position intact to continue appreciating. The spread here isn't between two investment returns. It's between the cost of the loan and the cost of the alternative, 6% interest versus 23.8% capital gains tax. That gap, nearly 18 percentage points, is the strategy. Borrowing is just structurally cheaper than selling. Now you're probably thinking, but the loan has to be repaid eventually, right? And here is where the third word in the strategy does its work: die. Under current U.S. tax law, when Thomas passes his assets to his heirs, those assets receive what's called a stepped-up basis. The cost basis resets to the fair market value at the time of inheritance. Every dollar of capital gains that accumulated over Thomas's lifetime, the $58 million gain on that original $2 million investment, is completely wiped from the tax record. His heirs inherit the asset at its current value. The deferred tax bill that was never paid disappears entirely. The portfolio loan gets settled from the estate. What remains passes to the next generation, essentially tax-free on the appreciation side. This is not a technicality. It is a codified feature of the U.S. tax system that has survived repeated legislative scrutiny because the capital it protects tends to be deeply embedded in businesses, real estate holdings, and investment vehicles that would be severely disrupted by forced liquidation at death. Whether that's the right policy is a separate conversation. As a mechanism, it functions exactly as described. The risk in this strategy is real and worth naming directly. Portfolio loans are collateralized against asset values. If markets drop sharply, the bank can issue a margin call, demanding additional collateral or immediate repayment. If Thomas can't meet the call, the bank liquidates his positions at the worst possible moment, at depressed prices, potentially triggering the very tax event the strategy was designed to avoid. Leverage at this scale requires assets large enough and diversified enough to absorb significant drawdowns without breaching collateral thresholds. This is not a strategy that forgives thin margins, but for those with the asset base to manage the downside, the logic is airtight. Never sell. Borrow against what you own. Let appreciation and time do the rest. Pass it on with the tax clock reset to zero. What's striking about buy, borrow, die is that its power comes entirely from patience, from holding assets long enough that the spread between borrowing cost and tax liability becomes impossible to ignore. The next strategy runs on something almost opposite. Not patience, speed. Specifically, how fast a single dollar of capital can move through multiple deals before most investors have finished analyzing the first one. That's the velocity of money, and it's where the compounding logic of debt starts to feel less like finance and more like physics. Two investors start with the same amount of capital, same market, same asset class. 5 years later, one has doubled their money. The other has built a portfolio worth 4 times what they started with. The difference isn't intelligence, it isn't connections, it isn't even deal quality. It's how many times each investor put the same dollar to work inside those 5 years. One of them let capital sit, the other kept it moving. And debt is what made the difference. This is the velocity of money. And it's the least discussed multiplier in personal finance. Most people think about investing in terms of return percentage. Buy something that goes up 10%. That's a 10% return. Clean and simple. But that framing ignores a second variable that matters just as much: how frequently you can cycle that return. A 10% return on a dollar that you recycle 3 times in 5 years is not the same as a 10% return on a dollar that sits in one deal for 5 years. The math on the first is dramatically better, not because the return rate changed, because the frequency did. Debt is what enables the frequency. Here's the mechanism in practice. Kevin is an electrician who started buying small rental properties in his late 20s. His first purchase was a 2-unit property that needed significant work. He bought it for $210,000, put $42,000 down, and spent $38,000 renovating. Total personal capital deployed, $80,000. After renovation, the property appraised at $310,000. He refinanced at 80%, $248,000, paid off the original mortgage of $168,000, and pulled out $80,000 in cash. His own money fully returned. That took 18 months. Now the clock resets. He takes that same $80,000 and does it again. Different property, same sequence. Acquire with debt, improve, refinance, recover capital, redeploy. By the time most investors are still holding their first asset and waiting for long-term appreciation, Kevin is entering his third deal with the same original $80,000 that funded the first one. He owns 3 properties. His personal capital is still $80,000. The debt is doing the heavy lifting. Now zoom out for a second. Over 5 years, Kevin cycles that capital through 4 complete transactions. Each property appreciates. Each one generates rental income that services the debt. Each refinance returns his equity and frees it for the next acquisition. The portfolio grows not because Kevin found unusually high returns, but because he refused to let capital sit idle inside a completed deal. Velocity compounded what patience alone never could have. Currently in markets where rental demand is outpacing supply, and there are dozens of them across the US right now, investors executing this cycle are building portfolios in the $3 to $5 million range within a decade, starting from capital bases under $200,000. That's not a projection. It's the arithmetic of recycled equity applied consistently over time. The risk here is execution risk. Each deal in the sequence has to underwrite correctly. The renovation has to come in close to budget. The appraisal has to support the refinance. The rental income has to cover the new debt service. One deal that goes sideways doesn't just hurt that property. It can freeze the capital that was supposed to fund the next one. The velocity strategy has no tolerance for sloppy assumptions, because each transaction depends on the one before it completing cleanly. But that's a risk of execution, not of the mechanism itself. The mechanism is sound. Capital that moves earns more than capital that waits. Debt is the vehicle that keeps it moving. The investor who understands this stops asking how much they can save and starts asking how efficiently they can cycle what they already have. 5 strategies, one thread running through all of them. Debt, structured correctly around the right asset at the right cost, doesn't drain wealth. It builds it. The question was never whether to use borrowed money. The question was always whether you understood the rules well enough to use it on the right side of the equation. And once that clicks, really clicks, the way you look at every financial decision quietly changes. 5 strategies, 5 different mechanisms, one underlying truth running through all of them. Debt is not the opposite of wealth. For most people who end up with serious money, it was the primary tool they used to build it. The confusion was never about discipline or income. It was about which side of the spread you were standing on. A few things worth carrying forward. The cost of borrowing is not fixed. Your credit, your assets, and your negotiating position all move that number. Paper losses can offset real income, legally and by design. Selling is often the most expensive way to access wealth you already have, and capital that moves builds more than capital that waits. Watch for the moment in your own financial life when you're making a decision about debt, and ask one question before anything else. What is this money going to earn relative to what it costs me to borrow it? That single question separates the 2 ways of thinking about borrowed money that this entire video was built around. There's a related question this video didn't fully answer. If debt builds wealth on the way up, what happens to it when the cycle turns? That's where the real stress test begins.